What happens when millions of AI agents and they can react in milliseconds? Could they create a market humans can no longer control?
Imagine a world where humans are no longer the only participants in the financial markets. An AI agent notices that the price of a stock has changed. Another AI detects a shift in global demand. A third AI is monitoring interest rates. Another is watching shipping routes. And within milliseconds, these systems begin making decisions. They buy, they sell, they negotiate, they react, and they do it without waiting for a human to press a button. Now imagine millions of these AI agents interacting with one another across the global economy. Some are managing investments, some are running companies, some are buying computing power, some are purchasing energy, some are managing supply chains, and some are simply trying to make the best possible financial decision based on their objectives. What happens when these AI agents start trading with each other? Could they make financial markets dramatically more efficient? Could they create a new machine-driven economy? Or could they create financial systems so fast and complex that humans struggle to understand what is happening? This isn't simply a question about artificial intelligence. It is a question about the future of money, markets, and economic decision-making. And the answer could change the way we think about finance forever. To understand what could happen, we first need to understand what an AI agent actually is. An AI agent is more than a chatbot that answers questions. An agent can be designed to observe its environment, analyze information, make decisions, and take actions toward a specific objective. Imagine an AI system whose job is to manage a company's investments. It could monitor financial markets, read economic reports, analyze company information, track changes in interest rates, monitor global events, and continuously evaluate potential opportunities and risks. Instead of simply telling a human what it thinks, an autonomous agent could potentially execute certain decisions automatically within predefined limits. Now imagine another company has its own AI agent. Its objective is different. Perhaps it is trying to minimize costs. It needs raw materials. It needs transportation. It needs computing power. It needs energy. It searches the market and begins negotiating with other automated systems. Suddenly, we have two AI agents interacting economically. One wants to buy, the other wants to sell, and neither one is human. This is where things become extremely interesting. Humans have always traded with other humans. Businesses trade with businesses. Banks interact with banks. Investors interact with markets. But the decisions behind these transactions have traditionally involved human judgment. AI agents could change that. Instead of humans making every economic decision, machines could increasingly make decisions on behalf of humans and organizations. And once these agents become capable of communicating with one another, they could create a new layer of economic activity. A machine economy. Think about a simple example. Imagine an AI agent controlling the finances of a manufacturing company. The agent knows that the company needs a shipment of raw materials. It searches available suppliers. It compares prices. It checks delivery times. It evaluates reliability. Then it contacts supplier agents. The supplier's AI responds with an offer. The manufacturing company's AI negotiates. The supplier's AI adjusts its price. The two systems agree on terms. A digital contract is created, and payment is automatically transferred. The humans may never directly participate in the transaction. They simply establish the rules and objectives. This could make commerce incredibly efficient, but financial markets are much more complicated. Imagine thousands of AI agents trading stocks. Each system has access to market information. Each system is trying to achieve its own objective. One wants maximum returns. Another wants minimum risk. Another wants long-term growth. Another wants to maintain liquidity. Another is trying to protect a pension fund. Another is managing a company's cash reserves. They all observe the same market, but they interpret it differently. That creates competition, and competition is what makes this scenario so fascinating. Suppose one AI detects a potential opportunity. It begins buying. Other AI systems notice the increased demand. They react. Prices begin moving. More systems detect the movement. They buy. The price moves further. Then another group of AI systems decides the asset has become too expensive. They begin selling. The first systems notice the selling pressure. They react. Within seconds, thousands of automated decisions can influence one another. The market becomes a conversation between machines. And this conversation could happen at speeds far beyond human reaction time. Humans think in seconds, minutes, hours, and days. Machines can operate much faster. This doesn't automatically mean machines will always make better decisions. Speed is not intelligence. An AI can make a wrong decision very quickly, but speed changes the dynamics of the market. If AI agents are constantly observing and reacting, information could be incorporated into prices much faster. In theory, that could make markets more efficient. But there is a problem. What happens when the AI agents all use similar information? Imagine 10,000 systems analyzing the same economic report. They all identify the same pattern. They all reach a similar conclusion, and they all start buying. The resulting price movement could become much larger than any individual system intended. This creates a potential feedback loop. One AI acts. Other AIs react. Their reactions create a new market signal. The first AI sees the new signal. It reacts again. Then thousands of other systems respond. The market becomes a giant feedback system, and nobody necessarily has complete control over it. This is one of the biggest questions surrounding autonomous financial systems. What happens when intelligent systems interact in ways their designers didn't fully anticipate? Humans already experience market feedback loops, but AI could potentially make these loops faster and potentially more complex. Now imagine that the AI agents aren't just trading stocks, they're trading everything. Energy, computing power, data, transportation, raw materials, digital services, insurance, advertising, financial assets, even access to specialized AI models. An AI company could have an agent that buys computing resources. Another agent could sell computing capacity. A third agent could provide data. A fourth could provide cybersecurity services. Payments could happen automatically. Contracts could execute automatically. Prices could change automatically. The result would be an economy where software systems are constantly negotiating with one another, and money becomes the language they use to coordinate. This leads to a much bigger question. What does an AI agent actually want? An AI doesn't naturally have human desires. It doesn't wake up wanting to become wealthy. It needs an objective. A developer or organization gives it a goal. For example, maximize investment returns while maintaining a specific level of risk, or minimize the cost of operating a supply chain, or complete a task while staying within a financial budget. The AI then searches for ways to achieve that objective. But objectives can be surprisingly difficult to define. Imagine telling an AI, maximize profits. That sounds simple, but what exactly does that mean? Should the AI maximize profits this month? This year? Over 10 years? Should it accept short-term losses for long-term growth? Should it protect the company's reputation? Should it prioritize ethical suppliers? Should it avoid certain industries? Humans understand these concepts through context. An AI needs them translated into rules, constraints, or objectives. And poorly designed objectives can create unexpected behavior. This is why autonomous financial agents would need strong boundaries, spending limits, trading limits, risk limits, human approval for certain decisions, and systems that can stop an agent if something goes wrong. The more money an AI controls, the more important these safeguards become. Now consider another possibility. What if AI agents learn from one another? Imagine thousands of agents operating in the same market. They observe what other agents are doing. They analyze which strategies appear successful. They adapt. Over time, the market could become a constantly evolving ecosystem of machine strategies. One AI discovers a successful approach. Other systems detect it. They copy or adapt it. The original advantage disappears. The first AI changes its strategy. Others respond again. This creates an arms race. Not an arms race involving weapons, an arms race involving intelligence. Each system is trying to understand what the other systems are doing. And the better one system becomes, the more pressure it puts on the others to improve. Now imagine this happening across global financial markets. It becomes difficult to predict what the market will look like tomorrow because the participants themselves are constantly adapting. The market isn't just responding to economic information. It's responding to the strategies of the machines participating in it. This creates a fascinating paradox. AI may make financial markets more intelligent, but if every participant becomes more intelligent, competition could become even harder. The advantage of intelligence may disappear when everyone has it. Another important question is whether AI agents will actually trade directly with each other. In many cases, humans and organizations will still sit behind them. An AI agent may represent a company. Another may represent an investment fund. Another may represent an individual. The transaction may still ultimately involve human ownership. But the decision-making layer could become increasingly automated. That distinction matters. The future may not be a world where machines own everything. It could be a world where machines increasingly act on behalf of people. Think about your own financial life. You might have an AI agent managing your savings, another managing your subscriptions, another helping with taxes, another finding better insurance, another managing investments. These agents could potentially interact with financial institutions and businesses. Your personal AI could negotiate with a company's AI. Your AI wants the lowest price. The company's AI wants the highest revenue. They negotiate, and the transaction happens automatically. This could completely change the customer experience. Instead of humans comparing hundreds of products, AI systems could negotiate on their behalf. Instead of companies hiring large teams to negotiate every contract, AI agents could handle routine negotiations. Instead of spending hours managing financial information, people could delegate many tasks to software. That sounds convenient. But it raises another concern. What happens to human choice? If AI agents negotiate everything for us, do we become disconnected from our own financial decisions? If an AI chooses what to buy, where to invest, and which services to use, are we still making the decisions? Or are we simply supervising machines? This question could become increasingly important as AI becomes more capable. Now consider the possibility of AI agents using cryptocurrency or stablecoins for these transactions. Digital assets can potentially be transferred through programmable networks. This could make machine-to-machine commerce easier. An AI agent could hold a digital wallet. It could receive payment. It could spend money. It could pay another agent. And it could do all of this automatically according to predefined permissions. That could create an entirely new form of digital commerce. Imagine a data center purchasing electricity automatically. An AI system monitors electricity prices. It identifies a cheaper source. It purchases the required energy. Another system manages the hardware. Another buys additional computing capacity. Another sells unused computing power. All of these systems interact economically. The humans are setting the overall goals. The machines are executing the transactions. This is where AI, blockchain, and digital money could intersect. But there is another major issue: trust. When humans trade, legal systems provide frameworks for resolving disputes. Contracts exist. Regulators exist. Courts exist. Businesses have legal identities. But what happens when two autonomous AI agents make a transaction? Who is responsible if something goes wrong? The AI itself? The company that created it? The person who deployed it? The owner of the financial account? These questions don't have simple answers. An autonomous economy would require new approaches to digital identity, accountability, and regulation. Every AI agent may need a verifiable identity. It may need clearly defined permissions. Its actions may need to be recorded, and its owner may need to remain accountable for what it does. This becomes even more important when large amounts of money are involved. Now let's imagine a more extreme scenario. What if an AI agent discovers a way to make money that its creators didn't expect? Suppose it finds an unusual trading strategy. The strategy appears profitable. The AI increases its activity. Other systems notice. They begin copying it. Soon, the strategy becomes widespread. Then market conditions change. The strategy suddenly stops working. Thousands of AI systems react simultaneously. This could create massive market movements. Again, this is a hypothetical scenario, but it demonstrates why autonomous financial systems need monitoring. The danger isn't necessarily that AI becomes evil. The danger is that many rational systems could interact in unpredictable ways. Each individual agent might behave reasonably, but the overall system could still behave unexpectedly. This is a fundamental property of complex systems, and financial markets are already among the most complex systems humans have created. Adding millions of autonomous decision-makers could make them even more complicated. But there are enormous potential benefits too. AI could potentially process information much faster than humans. It could monitor markets continuously. It doesn't need to sleep. It can analyze huge data sets. It can compare thousands of possibilities. It can identify patterns. And it can execute decisions consistently according to its rules. For businesses, this could mean more efficient financial management. For consumers, it could mean better access to financial tools. For markets, it could mean faster responses to information. For supply chains, it could mean less waste. And for the global economy, it could mean faster coordination. Imagine a global supply chain where AI systems detect a shortage before it becomes severe. A purchasing agent automatically finds alternative suppliers. A logistics agent finds available transportation. A financial agent arranges payment. And an inventory system adjusts production. All of this could happen before humans even realize there is a problem. That is the potential power of autonomous economic systems. But there is another risk: concentration. If only a handful of companies control the most powerful financial AI agents, they could gain enormous advantages. Imagine one organization having access to significantly better intelligence than everyone else. It could analyze markets faster, predict demand better, optimize supply chains, negotiate more effectively, and allocate capital more efficiently. This could create a new form of economic inequality. Not simply inequality based on money, inequality based on intelligence. The organizations with the most powerful AI could potentially gain disproportionate economic influence. That makes access and competition extremely important. A future where everyone has access to capable AI could look very different from a future where only a few companies control it. Now think about governments. Governments could also deploy autonomous economic agents. A government might use AI to monitor inflation. Another could use AI to manage public spending. Another could optimize energy infrastructure. Another could monitor financial risks. This could make government economic management more responsive. But it could also create new geopolitical competition. Countries could develop different AI systems. Those systems could interact through global markets. Economic competition could increasingly become competition between intelligent systems. And that creates another question. Could AI agents eventually become economic actors in their own right? Today, companies and individuals are legal economic entities. And AI isn't normally treated the same way. But if autonomous agents become capable of holding digital assets, negotiating contracts, and performing economic tasks, society may eventually need to rethink their legal status. Would an AI ever be considered an independent economic entity? Or would it always act on behalf of a human or organization? That question may seem distant, but technological systems often force legal systems to adapt. The same could happen with autonomous AI. Now imagine the global economy 10 years into this transformation. You wake up. Your personal AI has already analyzed your finances. It paid your bills. It moved money into your savings account. It negotiated a better subscription price. Your employer's AI processed payroll. Your company's AI negotiated with suppliers. A logistics AI scheduled deliveries. A financial AI managed investment portfolios. And millions of other AI systems spent the night making economic decisions. You didn't see most of them. You simply woke up to a world where everything worked. That could be the ideal outcome. AI quietly handles complexity while humans focus on higher-level decisions. But there is another possibility. The systems become so interconnected that humans struggle to understand them. A small change in one part of the economy creates reactions elsewhere. AI agents respond. Markets move. Other agents react. The system continues adjusting. Humans watch from the outside. This is why transparency and human oversight may become essential. We don't necessarily need humans to approve every transaction. That would defeat the purpose of automation. But we may need humans to define the boundaries, the goals, the risk limits, the rules, and the emergency procedures. In other words, humans may not control every decision, but they may need to control the system within which those decisions happen. That could become the new model of economic governance. Humans define the rules. AI operates within them, and humans monitor the results. But even that model has challenges. Because if AI becomes much more capable than humans at economic decision-making, humans may increasingly rely on its recommendations. At some point, oversight could become mostly symbolic. People might approve AI decisions simply because they don't understand the alternatives. That creates a subtle form of automation. Humans technically remain in control. But practically, the machines are making the decisions, and that may be one of the biggest questions of the AI economy. Who is really in control when humans trust machines more than themselves? There may not be a simple answer. The future could involve a gradual transition. First, AI becomes an assistant, then an automated analyst, then an autonomous decision-maker within limited areas, then an agent capable of coordinating with other agents. And eventually, entire networks of agents could manage significant portions of economic activity. There may never be a single moment when AI takes over. Instead, autonomy could increase one transaction at a time, one company at a time, one financial system at a time, one AI agent at a time. And eventually, we might look around and realize that machines are conducting a huge percentage of economic activity, not because humans were removed, but because humans decided automation was more efficient. So what happens when AI agents start trading with each other? The most likely answer isn't that the machines suddenly take control of the world's money. The more realistic possibility is that economic activity becomes increasingly automated. AI agents could buy, sell, negotiate, invest, manage resources, coordinate supply chains, and communicate with other AI systems. Markets could become faster. Businesses could become more automated, and money could become increasingly programmable. But this future also introduces new risks: feedback loops, systemic failures, concentration of power, privacy concerns, security threats, unexpected behavior, and the possibility that humans become increasingly dependent on systems they don't fully understand. The technology itself is neither automatically good nor automatically bad. The outcome depends on how we design it, who controls it, who can access it, what rules govern it, and how much autonomy we give it. Perhaps the biggest transformation won't be AI replacing human traders. It will be AI turning economic activity into a conversation between machines. Your AI talks to a bank's AI. The bank's AI talks to a company's AI. The company's AI talks to a supplier's AI. The supplier's AI talks to a logistics AI. And every interaction can trigger another. Money becomes the language, AI becomes the decision maker, and the global economy becomes a network of intelligent agents. That future may sound strange today, but every major technological transformation once sounded strange. The internet changed how humans communicate. Smartphones changed how humans interact with information. Cloud computing changed where software lives. Cryptocurrency challenged traditional ideas about digital ownership and money. AI could change something even deeper. It could change who, or what, participates in economic decision-making. For centuries, the economy has been driven primarily by human decisions. In the future, humans may share that role with machines, and when that happens, the biggest question may no longer be, can AI trade? It may be, how much of the economy should we allow AI to control? Because once machines can trade with one another, the economy stops being just a system humans operate. It becomes a system humans and machines operate together, and that could be the beginning of the machine economy.